financial statement, in accounting, financial statement of sole traders. When we talk about sole traders, we're talking about a business that is owned and controlled by an individual. So that means an individual owns and controls the business. That makes it that makes that individual or that business a sole trader. So for the sole trader, a sole trader will open a financial statement. And the two financial statements a sole trader will open is one, the statement of financial position, and two, the statement of profit or loss and other comprehensive income. So let's see what I wrote here. I wrote, financial statements are prepared in order to provide information about the performance and the financial position of the business to all users of accounting information to make economic decisions. So why will a business needs to prepare a financial statement? The financial statement is being prepared to show the performance of the business to the users of accounting information so that they will be able to take decisions regarding the business. So first, we have to open the financial statement to show how the business is doing, to really show how the business is doing in terms of its performance, and also to know the financial status of the business. So, what are the two financial statements opened by a sole trader? One, a sole trader will open the statement of profit or loss and other comprehensive income and a statement of financial position. So these are the two accounts a sole trader will open. So we start with the statement of profit or loss and other comprehensive income. For the statement of profit or loss and other comprehensive income, I wrote, this financial statement contains the expenses and revenue of the business for the financial year. So, as a business, you would make money. The money you make from the sales of your product or service is called or known as revenue. But your expenses are also there because as you are making money, you are also spending. So, spendings within the business is known or are known as expenses. So expenses are spending between the business. Revenue are what the business makes in terms of sales. So for the statement of profit and other comprehensive income, we have two sections. We have the trading section and profit or loss section. So we start with the trading section, which is the trading account. For trading account, I wrote, this section records the amount made in terms of revenue and profits made during trade. So a business will trade. In the course of trading, the business will make revenue. So the revenue the business makes during the course of trading is the sales for the business. And at the same time, the business will also make profit. So how will the business calculate its profit? Where will it calculate it from? The profit will be calculated from the revenue the business made and the cost of its sales. So look at what I wrote here. Trading account contains the revenue earned from sales and the cost of these sales, of those sales. The difference gives the gross profit. So for the gross profit, the business will calculate its gross profit by revenue minus cost of those sales. So our gross profit is revenue minus cost of sales. That is how a business will calculate its gross profit. So, the items we have in the trading account, are as follows. First, we have revenue. We just talked about revenue. Now, what is revenue? The amount of money made from the sales of a product or service. That is revenue. The amount of money made by the business from the sales of a product or service is revenue. So, then we have revenue returns. For revenue returns, it means those products or services that the business has previously sold to customers that customers are returning. Those products that the business has sold to customers, or those services that the business has sold to the customers that the customers are returning, we call it revenue returns or returns inwards. So that is revenue returns. Then we have the cost of sales. For your revenue in the trading account, what you do with the trading account is this. In that section, revenue will be less from revenue returns. That means the sales of the product minus or less the returns take them away. That's how you get your revenue. Then we go to cost of sales. Remember we said gross profit is revenue minus cost of sales. For our revenue is revenue minus revenue returns. That's sales minus sales returns, return inward. Then, for our cost of sales, what are the items that contains the cost of sales? Look at what I wrote here. I wrote the items here are directly involved in the calculation of the cost of sales. So all items here are involved in how we calculate our cost of sales. The first one, opening inventory. We're talking about inventory. Inventory are the stocks that the business sells. So what makes it an opening inventory? We call it opening inventory because this inventory were from the previous accounting period that has brought forward to the present accounting period to be sold. So here I wrote, this is the inventory that is brought forward from the previous accounting year, hoping to be sold in the current financial year. So we call it opening inventory because it has been carried forward from last year onto this year, hoping that we're going to sell it this year. You had this with purchases. What are purchases? Purchases are what the business bought from suppliers. So here I wrote, this is the cost of goods bought from suppliers for resale by the business. So purchases will be added to your opening inventory. Opening inventory are the products you have available, the stocks you have carried forward from the last year. Then whatever you buy this year, we call it purchases. You add it to your opening inventory. Then we go to this. Return outward. For return outward, it means that what the business has bought from supplier, the business is returning it back to supplier. That is purchases returns. It's different from sales returns. For sales returns, what the business sold to customers that the customers are returning, we call it sales returns. We less it from sales. But for purchases returns, we less it from purchases. That's why we said less returns outward. So another name for purchases returns is returns outward. And another name for sales returns or revenue returns is returns inwards. So you let your return inward, outward from purchases. Then the next one is carriage inwards. What are carriage inwards? Carriage inwards are the cost of delivering products to the premises of the business. So the amount to spend in transporting the products to your premises from your supplier is called carriage inward. So you have the carriage inward to your purchases. So that means your opening inventory plus purchases, you less your purchases returns, then you have your carrying inwards, which is also an expenses to the business. Then, less inventory drawings. What are inventory drawings? Inventory drawings are those inventory that the business, the owner of the business, take or took from the business for its own personal use. So that means from the stocks in the business, the owner of the business has taken certain stock for its own usage. So because the owner of the business takes it, and in accounting concept, the business must be separated from the owner of the business. That is why we have drawings. So you less these from your cost of sales. Then the last one, closing inventory. What are closing inventory and why do we have to less it from the cost of sales? Our closing inventory are the value of inventory that is left in this current accounting year that will be carried over to become opening inventory in the subsequent accounting year. So your closing inventory will be less from your cost of sales. So it means these are the value of stocks available in the stock or in the business. So how do we calculate our gross profit? So this is gross profit. Gross profit is revenue minus costs of sales. So for revenue, we say revenue, we have revenue less on the credit side of your trading account, revenue less revenue returns. Whatever you get here, you minus it from your cost of sales. So for your cost of sales, how do we get it? You have opening inventory plus purchases minus purchases returns plus carriage inwards minus inventory drawings, then minus closing